Welcome to Business Owner Bootcamp, the Wealthspire Advisors podcast designed to help business owners and entrepreneurs take control of their finances. Hosts and financial advisors Michael Delgass and Sandy Wiggins break down key topics like tax strategies, exit planning, business valuations, and real-world experiences with expert guests. And now, here are your hosts, Michael Delgass and Sandy Wiggins.
Hello, everyone. My name is Mike Delgass, and I'm a co-host of Wealthspire's Business Owners Bootcamp podcast. I'm joined today by my co-host and colleague, Sandy Wiggins. Say hi, Sandy.
Hey there, Mike. Good to be here this morning.
Good to see you. This is the 6th episode in that podcast series, and I hope you will continue to join us for future episodes where we will discuss working with investment bankers on a business sale, planning for personal fulfillment post-sale, further advanced tax planning, and a lot of, we hope, really interesting topics to business owners. Sandy and I are advisors at Wealthspire. We work with clients across the country with a special focus on families that own closely held businesses. We're joined today by one of our wealth strategists, Liz Sommers. Liz is a former estate planning attorney, a certified exit planning advisor, a CEPA, and a member of our family wealth team here at Wealthspire. He has a lot of experience working with business owners on their personal planning, both before and after the sale of a business. And we're going to cover a lot of ground today regarding the importance of this type of planning. So welcome, Liz. Say hi.
Hi, everyone. Thanks for having me.
Thanks for being here. So look, can you tell us a bit more about what you do here at Wealthspire and how you work with our clients?
Sure, absolutely. So as mentioned, I am a recovering estate planning attorney. I made the jump over to what I think of as the light side with wealth management a few years ago. And I really get to do sort of all of the fun parts of my former job, but without the billable hour. So I can review client documents, I can provide education on opportunities for additional wealth transfer, and I can keep you up to date on changes or potential changes to the tax law. So another thing I really pride myself on doing is, you might get a sense already that there's a reason I wasn't a litigator. I'm really focused on a team-based approach. So to the extent that I can work with your outside advisors, your attorney, your accountant, just to make sure we're all paddling the canoe in the same direction, it's a big part of what I do here as well.
Thank you. As a recovering business planning and tax attorney myself, I definitely appreciate the need to get away from the tyranny of the billable hour. So in that vein, from a high level, what are the things that business owners need to be thinking about from a planning perspective pre-sale before a sale of a business?
Absolutely. So there are kind of 4 main things that I like to think about. And again, pretty much everything that we talk about today could be its own hour-plus podcast. There's a lot of meat on the bone. But in general, I think first and most importantly, we want to be thinking about our timeline. For some of the strategies that might make a really big impact for business owners in the pre-liquidity sense, we need to be thinking about this pretty far in advance of a sale. For example, to make sure we're taking full advantage of the qualified small business stock regime, we should be thinking at least 5 years out, if not more. If we're not taking advantage of QSBS, I still want to talk to you at least 1 to 3 years in advance. But that said, do not panic. I get a lot of calls and have gotten a lot of calls over my career that say, okay, I signed my letter of intent and I'm ready to start planning. And while it breaks my heart a little bit because some of our opportunities are gone, there's still a lot that we can do to, do some thoughtful wealth transfer, to make sure the process as a whole goes more smoothly, and to really do some thoughtful planning and some thoughtful capital gain management as well.
Liz, you mentioned the concept of losing that opportunity. So let's talk a little bit about what you mean by that, right? Signing the document eliminates some opportunities. So maybe expand a little bit on what you mean by that, if you don't mind.
Absolutely. And you'll hear me talk about this a little bit more or in more detail in a minute. But really, when we have closely held business, we have an asset whose value is, for lack of a better word, a little bit murky. It's not like a share of Apple stock, right? We can't there's no to Google and find out what it's worth in 2 seconds. Because of that, we have the ability to potentially have some wiggle room when it comes to the valuation of that business especially if we're transferring interest in that business well in advance of a sale. So when there's no immediate buyer and when there's no public value, the value is really what a qualified appraiser will tell us it is worth. And if we're transferring non-voting interests in our business, we could be, really eligible for further discounts for lack of control and lack of marketability that really allow us to take an asset that, in the future may be worth, 10x and transfer it at a gift tax cost of X. So that's why we want to, move sooner rather than later. And also it's really important from a timing context because once we have sort of a binding commitment to sell, once we have a signed letter of intent, that the market has spoken. Our wiggle room really disappears. We have a new fair market value, and we don't have those opportunities to transfer for a little bit less that maybe we had before.
I guess I would point out that even in a signed letter of intent, there's some possibility the deal doesn't close. So, if you really back against the wall, that's where you are. There might still be some things you can do from a valuation standpoint, but yeah, there are a lot of doors that have closed for sure. You mentioned valuation, you mentioned gifting. What are
Yeah.
some of the other wealth transfer techniques that we might deploy, and what's the timing around those?
For sure. So in addition to gifting assets into, say, and you're going to hear me use this phrase a lot, a properly structured irrevocable trust, we can also sell assets to that trust as well for, what will typically, again, be a much lower value earlier in the process. So there are techniques that we can use to move those assets outside of our estate sooner rather than later. We also have access to what I think of as kind of the alphabet soup of estate planning vehicles. One that's very popular, of course, is a grantor retained annuity trust, or GRAT, where we transfer interest in the business into this irrevocable trust in exchange for an annuity that comes back to us. To the extent that that asset appreciates in excess of what we need to receive back in return, which is what we put in plus a small federally prescribed interest amount, anything over and above that passes to our remainder beneficiaries, really gift and estate tax free. So there are a number of levers that we can really push when it comes to moving interests in this business outside of our estate at a lower value prior to sale. Again, many of these techniques also available to us after the sale. It's just that it's not going to be quite as sweet as it was earlier in the process.
Well, it takes time to learn and understand what the client's goals are from our side of the equation. And it takes time and energy for the client to develop an understanding of the tools that they have access to. And then you assimilate that and put a strategy together. So, as you said, the sooner we can start on that process, the easier the pace is, the more thoughtful we can be as a team. And ultimately that leads to a much better outcome, not only for the specific transaction, but the fallout of that as it relates to family wealth, charity, the community. Time is our friend when we've got plenty of it, but it can work against us when we're under the clock, so to speak.
Yeah, good point.
I absolutely agree. And one thing I do want to note is I am your paranoid conservative estate planning attorney, right? I am very, very gentle and thoughtful in terms of my approach to risk. If that is not you, there are certainly attorneys out there that can take a more aggressive stance, but what you'll generally be hearing from me is sort of the stuff that we know will work that is relatively low risk. So I always like to say that because all of our clients have different risk appetites and appetites, more importantly, for complexity. So to Sandy's point, it's really important to sit down as part of this greater discussion and think about not only, what are my goals in terms of tax efficiency and wealth transfer, but what also, do I personally have the bandwidth to take on, right? So just a note there.
And in
Yeah,
your role, go ahead, Mike, sorry.
Well, I was just going to say that, and also clients have different appetites for flexibility or the loss of flexibility. So sometimes you need the complexity in order to get the optionality, the flexibility. And so there's a little bit of a push and pull there sometimes. So for instance, like a spousal lifetime access trust, right? Has a lot of benefits for a married couple who might be selling, but introduces another level of risk that makes it a little less, plain vanilla, but does allow a lot of flexibility in terms of accessing gifted dollars down the road. Sorry, Sandy, go ahead.
Well, yeah, and building on that thought there, I think about the SLAT, and it makes me focus on some conversations Liz and I've had recently with a much older couple and a much younger couple, and their age influences the tools that they're interested in using. And so, Liz, in your role, I think one of the greatest contributions you make is to educate people on what their options are. And that's what we're talking about today. You're not, you mentioned being conservative. You're putting things on the table. You're talking about the pros, the cons, the considerations. And then we, as a team, work with the client, their counsel, to kind of put those estate planning documents in place. So, as you said, you're not on the billable hour. You get that great opportunity of educating people and helping them understand what the options are. And then, we as a team put the puzzle together.
I love that. I love a team-based approach. And, frankly, I do think, don't tell anyone, I have the best job in wealth management, not to brag, but it is fun. It's great to sit down with people and really do that kind of deep discovery and then structure the plan around them. Not just, here's your tax efficient plan that an associate whipped out in 2 hours. We'll apply it to you, give it no thought. But things that really reflect your goals and your values and the individual members of your family that we've gotten to know. So I find that work really exciting.
There are questions that you're good at asking to help kind of start that thought process, and narrowing down a discussion on some of the tools. So what are some of the questions that business owners might want to begin to think about hearing our conversation today, so that we could build those strategies around a deeper understanding?
Sure, absolutely. And you're giving me access to one of my favorite soapboxes, which is that whatever else happens, we can do some really fascinating and complex and exciting planning here at Wealthspire. It's one of the reasons that I love this job. But at the end of the day, often it's the building block process that really informs the rest of the planning and helps make sure that we're covered no matter what else happens. So one thing I really, really stress, and this is so boring, I'm sorry, is that you really need an up-to-date core estate plan. So your pour-over will, revocable trust, powers of attorney, healthcare directive. We want to make sure that not only do you have these documents, but they're up to date. And what I mean by that is, do we have the right people in the right positions of authority over that trust agreement, over those agency relationships? Do we reflect all of the members of your family? I see lots of documents that stop at kid 1, and we have 3 more. Do we have the right state of residency? Just all of these really simple things. Are they tax efficient? Your estate plan is a set of living documents, and we should be looking at it minimum at least every 5 years, if not more often, especially if we have a major change, death, divorce, new grandchild, sale of a business. All of these are important inflection points. To horribly paraphrase Ferris Bueller, life goes by pretty fast. If you don't stop and look at your estate plan once in a while, you're not going to be happy with it. And in addition, that puts us in a good position, whatever happens with the sale, right? But that said, to back up and to echo Mike's point about the LOI and the fact that these transactions don't always go through, it's a really good exercise to help define our goals and values and set up some infrastructure in case this deal doesn't work out and we're going to continue on with an operating business. Let's put some thought into who's going to step into your shoes as the business owner when you're gone, make those decisions, carry things out, make sure we're providing for children who are in the business in a way that's appropriate, as well as providing for kids who are not in the business in a way that's appropriate, but maybe doesn't involve decision-making authority in the business. There are a number of levers we can push there, making sure that we're not leaving your spouse with, this incredible, I don't want to say burden, but this is something that maybe they're not comfortable with, that's left on their lap should you pass unexpectedly. Really, what this allows us to do is set up this kind of default plan. Um, so in the event that something happens to you, and again, in the morbid language of my profession, should you be hit by the bus tomorrow, we're not looking at a fire sale for this business that you've spent so much time and energy building.
Liz, you mentioned QSBS planning,
Yeah.
and we do have a pretty detailed episode about qualified small business stock already in the can that people can check out. I mean, that's a great pre-sale capital gain management technique. What are
Yes,
some other things we ought to be thinking about in the realm of capital gain taxes and how to manage those?
absolutely. So from a capital gain perspective, there are a couple of things that we want to keep top of mind. First and foremost, absolutely, is QSBS. And you and Kevin did just such an amazing job with that episode, so I encourage everyone to check it out. We can also think about potentially changing state of residency from a higher income tax state to a lower income tax state. We have to be very careful that we're doing that, in advance of sale, that we're crossing our T's and dotting our I's, and not just establishing residency someplace else, but terminating our current residency. We also want to be aware whenever we change residency. There are all different types of tax. Unfortunately, they are all interrelated in a sense. There's a vast web. So before you change residency, make sure that that's not going to affect any of the other tax benefits that you're looking into from a transaction perspective. One thing that leaps to mind immediately is that not all states conform with the federal treatment of QSBS.
Right.
So we want to make sure that we're not moving to a state where we could unfortunately experience a gain event when we weren't expecting one. Uh, Another that always leaps to mind, and this is one that's a little bit not a new program, but one that was recently expanded, is the Qualified Opportunity Zone regime. So this is a great opportunity actually for post-sale planning. Again, remember I noted that all is not lost if we don't get to it before the sale. But if you have realized but not yet recognized gain, you can roll that into what's known as a Qualified Opportunity Fund. This was meant originally under the Tax Cuts and Jobs Act to be a temporary program. The One Big Beautiful Bill Act that passed on July 4th expanded it into a permanent program and really added some very interesting benefits from my perspective. So with an investment in a qualified opportunity fund, you get gain deferral for 5 years, at which point you have to recognize. But then if you hold that same investment in the fund for 10 years or more, you have the ability to get a basis step up on that subsequent appreciation. So for investments in urban and suburban areas, the sort of traditional qualified opportunity fund, that step up is 10%, which is certainly nothing to sneeze at. But what the Act gave us, which I thought was really interesting and a great opportunity, is the Qualified Rural Opportunity Fund for investments in rural areas. And the special thing there is that that basis step up isn't 10%, it's 30%. So there's really a great, series of opportunities and benefits, many of which we're still uncovering, that came out of that act.
That's a great point. I would add though that
Of course.
the investments matter there also.
Yes,
And when you
absolutely.
are being driven into a few zip codes, because those are where the qualified opportunities are, whenever you see crowded trades, you have to take a step back and ask yourself, is the tax benefit worth the investment drag that I might be undertaking because, maybe there are a whole bunch of other people bidding up these prices and I'm not going to get in at good valuations and that kind of stuff. So there is a pretty complicated dance there between the tax benefits and the investment detriments potentially. But those are great things to talk about, and you don't have to do it with everything. And so you might
No,
have, some that's deferred into a qualified opportunity zone and some that isn't.
Well,
absolutely.
back to the concept of time, you need time to evaluate those investments, look at those opportunities, consider the tax implications.
Yeah.
And that's the commercial, start sooner rather than later.
Yeah.
If you take
Yeah.
one thing from this podcast, please call us.
Yes.
Right.
Start early.
Early.
Yeah.
But there are, and this is one of my favorites personally, but in addition to those sort of a more traditional means of gain management, I almost said secular, but that is incorrect. We also, of course, have the incredible lever of charitable contributions, either before the sale or after the sale. And that can make a really big impact when it comes to managing gain. That's, of course, because with a tax exempt entity, we get sort of a double benefit if we contribute assets prior to the sale. So not only do we get a charitable income tax deduction, which we always love to see, the built-in gain attached to that business interest effectively just evaporates, right? It's never recognized because the charity doesn't have to pay that tax. That said, I have a number of cautions when it comes to charitable planning before the sale. I think it can be a great option for the right client, someone who has the bandwidth, someone who is really charitably inclined. It's not for everyone because there are some potential pitfalls there. So in general, I would say just be aware that the charitable income tax deduction threshold is going to be lower for contributions of appreciated property than it would be for cash. So if that would be 30% of your AGI adjusted gross income with a 5-year carry forward for contributions to a public charity or a DAF. With a private foundation, our threshold is even lower. It's 20% for contributions of appreciated property. And in addition, we have sort of another hurdle there in that the value of that property is going to be the lower of its appraised fair market value or its basis. So we typically don't see a lot of pre-sale giving to a private foundation. Again, right client, right circumstances, everything's on the table, but not as popular as you might imagine. Again, because this is a business, it's not a closely held business, it's not a share of Apple stock. We need a qualified appraisal by a qualified appraiser to establish valuation. And we need to make sure that we're engaging with the organization that we hope to make a contribution to, because we are contributing a more complex asset when we're sending, an interest in a business. So reach out to the team at the Donor Advised Fund, reach out to the plan giving team at the charitable organization, and just really have an open flow of communication. That said, the biggest potential pitfall here is something called the anticipatory assignment of income doctrine. And while it's very fun to say, it is very, very bad in practice. So basically, if you make a contribution of property to a charitable organization after the time in which you have made a binding commitment to sell, from the IRS's perspective, you already own that income. And what happens is the charity may irrevocably own that interest and the proceeds of the sale, but you are still stuck with the tax bill and you don't have the assets to pay it like you did before. Again, that's a worst case scenario. And that's the number one reason why when we think about this, we want to make sure we're really, really careful in timing and we're working with our estate planning counsel to make sure we're doing this in sort of a safe way. We're not worried about the doctrine as long as there's not a binding commitment to sell, but sometimes a binding commitment to sell is a little bit of a gray area. So proceed with caution.
And you mentioned the
Those are great
estate
points.
planning attorney, obviously the transactional attorney is another player on the team, and coordinating all that is key.
Yes, 100%. And
So before we move to the post-sale planning, I just want to quickly point out another capital gain management technique that isn't so much about kind of the acronyms of estate planning. It's about the investment process. So there's a lot that Sandy and I can do along the way working with business owners in investing their liquid funds outside of the business to generate tax losses, but still get investment gains. So there's a lot of tax loss harvesting and other more sophisticated direct indexing that we can do for business owners that build up a pile of tax losses that never expire and ultimately can be used against the capital gain that you would get from the sale of a business.
I love that. And one quick note before I forget, we can also make a difference in post-sale planning and capital gain management with charitable contributions after the sale.
Tell us more about that. Yeah.
Absolutely. So the thing is, we go from having this really complex asset and we have requirements for timing and valuation, and we're nervous about it, to having, this lovely pot of cash and marketable securities. Wonderful. Easiest thing in the world to donate. So of course, with marketable securities, same thresholds apply, that 30% for appreciated property, 20% for private foundations. But if we were to contribute cash after the sale, we can deduct that up to 60% of our adjusted gross income with a public charity or a DAF, subject to that 5-year carry forward. So if you don't use it all up in year one, don't worry about it. That is reduced to 30% for contributions of cash to private foundations. But again, cash is cash. We're not worried about that basis reduction. And while there's no timing requirement, we're not racing, it might make sense, it almost certainly makes sense, to make those charitable contributions in the same year as the sale to help you offset a little bit of that capital gain. So, much, much more straightforward, easier to do, and maybe something that could be a great post-sale project, a place to kind of spend some of our energy while we're thinking about our next steps.
And you mentioned foundations and donor advised funds. There are charitable lead, charitable remainder trust. We won't get into those details today, but again, back to your role, and what we want to always do is educate our clients and listeners on what the options are so that you can put that puzzle together. And we don't necessarily want to overcomplicate things. That's reading the client. How willing are they to explore some of these things? But there's so many tools that we can use if we have time to look at them.
Great point.
Speaking of complexity, and maybe over complexity depending on the situation and the client, after a sale, you got your pile of money. When does it make sense to think about a family office, kind of going from the family business structure and replicating that into a new overall plan, a new ownership schema?
I think that's a great transition and a way to really provide some support for a family. So we see family offices for business owners after the sale and I'm sure you've never met anyone like this, and no one listening is like this at all, but for so many years, there was no separation of church and state, right? The personal was business, the business was personal. We ran our lifestyle needs through the business. It was all one entity. And the thing that we find is after the sale, that sort of lifestyle management, expense management is something that our business owners really miss. So if you are, a couple of months out, you're thinking about your next step, perhaps you're thinking about wealth transfer after the sale in a bigger way. And really you're missing that kind of center of operations for the way you live your life. It might make sense to look into, or at least explore, setting up a family office. And that's really a command center for all of the things that make up the world of a family of wealth. So, of course, we've got investment management, we've got wealth transfer planning, someone like me. We have concierge services, trust services, bookkeeping, bill pay, really all of the things that you need to kind of make the trains run on time. So there are a lot of ways to do that, whether you set up your single family office or whether you work with a provider to have sort of what I think of as family office light, where you don't have a formal office structure, but you have access to those services. Lots we can do. And I suspect you're having my colleague Jake Even on in a couple of weeks, and he is phenomenal in this area. So he will do a great job talking about not only the structuring elements, but also the potential income tax benefits.
So when we step back of what we've talked about today so far, we're talking about thinking about transfer of wealth before and after a transaction, and what does that mean, to the family, future generations, the community. Those are thoughtful questions and take time to answer. We're talking about tax, income tax, capital gains tax, estate tax. What in this big picture do we want to make sure we touch on before we conclude our conversation today? What have we missed?
Absolutely. Well, you're giving me an opportunity to do one of my favorite things, which is focus a little bit on the softer side, because I think it's as important, if sometimes not more important, than all of the technical, exciting things that I get to do. One thing I would underline for all of our business owners who are listening is that if you have built a successful business and you are now selling it, you are wired differently. All of that grit and work ethic and your personality and drive that got you to the place that you are, that does not go away the second you get a check in your account. You are still the same person. So I really encourage you to spend some time thinking about what your life is going to look like after the sale. And in so many ways, the things that we think are going to take up all this time when we get to take a break or retire, they don't take as much time as we think. I have a lot of business owners say, I'm going to go on a road trip across the US. I'm going to see the Grand Canyon. I'm going to go on this vacation. And because they've never been able to take that vacation, it's too much time for the past 20 years, it feels like it's going to expand to fill their whole life, and it won't. So I really encourage you to think about, what do I want to do with my next chapter? Do I want to be really involved in my community? Do I want to focus on my family's philanthropy? Do I want to do this sustained travel? Do I want to take another bite of the apple? Ideally, some combination of these things would be great. But as part of that process, and again, I'm going to out myself as a millennial, you really might want to consider, would it make sense to talk to a counselor? Would it make sense to get some coaching? As you move through this period of real transition in your life, that's frankly unprecedented. It can really help to get those insights.
I think those are great points, and we think they're so great, we're going to devote an entire episode of this podcast to that. No,
a nice tee up.
The lead in is great, so stay tuned for that as well. But on that note, I want to thank you, Liz, for joining Sandy and me here. This has been great. There's a lot of interesting stuff to talk about. I hope our listeners will check out some of the stuff on our website, because if you kind of caught the grantor retained annuity trust discussion, for instance, but didn't quite see where all the moving parts are, there's a white paper on that. If you want to see more about QSBS planning, there's a white paper on that. So I hope people will take advantage of the resources we have through this podcast, but also through many of the other writings stuff we have on the website.
Yeah, and what we covered today was, there's a lot of technical. Liz did a great job of talking about the softer side of things. And on one perspective, you might think, golly, this is super complicated. I don't want to deal with it. I'll put it off to tomorrow. I would suggest it's an opportunity to be creative, to be thoughtful, to be forward thinking. And that's what many of our clients and entrepreneurs bring to the table. They like a challenge. They like putting that puzzle together. And with the right people guiding you, it can make a huge difference for you, your family, and your community. So again, thanks, Liz and Mike, for the opportunity to chat today.
Thank you all.
Thanks for listening to this episode of Business Owner Bootcamp, presented by Wealthspire Advisors. If you have any feedback or questions, including suggestions for future topics and guests, reach out to your hosts or send us an email at clientrelations@wealthspire.com.